Welcome to video 4 of part 2 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here back with you to discuss deductions and credits. We have a lot of ground to cover in this one, so let's get started. What we will study specifically today are business deductions. Then we'll look more specifically at compensation and fringe benefits, and then we will talk about credits. As always, free resources available from irs.gov. We've got a pretty long list in this one. You've already seen publication 334, so recommending that one again. Then we get into this one, 535 business expenses. I'd also look at the passive activity and at-risk rules publication. And then if you're interested in these other ones as well, and travel, gift, and car expenses is probably another one to get into because the IRS is very concerned about those expenses and it is tested pretty heavily on the EA exam. And the rest of these are great too to get more information about the specifics of those topics. So, talking about business deductions, in general, and you're going to hear this a lot, so you're going to want to get familiar with this, with Section 162, it's called. To be tax deductible, expenses must be ordinary and necessary. That is the phrase that is used and that you will want to know for the exam. You will certainly get a question on this. Section 162, expenses must be ordinary and necessary. Now, the words ordinary and necessary don't necessarily have the meaning that you would think that they have just in the regular use of those words in day-to-day language. So ordinary here means the expense is common and accepted in the taxpayer's line of work. Necessary means the expense is helpful and appropriate for the taxpayer's trade or business. An expense does not have to be indispensable to be considered necessary. So normally we hear the word necessary, we think it's something that's absolutely, you have to have it. Your business could not run if you did not have this expense. But that is not what necessary means in this context. As it says there, it just means it is helpful and appropriate for the taxpayer's trade or business. Even when they say ordinary means the expense is common and accepted in the taxpayer's line of work, that's really not exactly true. You could have an expense that you're the only business in your particular industry that has ever had that expense, and it could still be tax deductible. So I like to think of ordinary and necessary just meaning that it really is truly in your heart of hearts, in the deepest part of your being, you know that this is, in fact, a business related expense. You're not stretching it. You're not trying to cheat even just a little bit, but this is legitimately an expense related directly to your business, to being in business. But for the exam, you need to know these definitions. So remember those definitions and remember Section 162, ordinary and necessary expenses. There are some things that are not deductible. Remember when we were talking about accounting methods, we said that there was differences between book and tax, and that most of the things on your business's P&L, the expenses, will be deductible, and that is true. But there are some exceptions, and so we want to make sure we highlight the major things that are not deductible. This may not be an all-inclusive list, but it's got the big ones. First and foremost, personal living and family expenses are never deductible. And this is the biggest one because this is the one you're going to see the most cases. This is the one the most people going to prison for. This is the one the most tax preparers losing their license and their ability to practice before the IRS for. This is the one that is going to be the biggest headlines in the news, is people trying to deduct personal living and family expenses. There will be, every once in a while, some quote unquote tax advisor or tax preparer who is going around and selling their services for large fees to try to teach you, as a taxpayer, how to deduct your personal living and family expenses. they'll make it sound fancy. They'll say, well, this is a special trust that's used by wealthy people in order to not pay taxes, but we are going to show you how to do it for a fee. We'll show you how to set up this trust. And then it'll have something to do with putting your business in the trust, and then putting your house in a trust, or putting your house in an LLC, and then renting your house to the business. And all of a sudden, you can deduct your mortgage interest, and you can deduct all of your food for your family because they're all employees, and so you're providing it for them to work. And you can deduct your children's private school tuition, and you can deduct the clothing that they wear. And then somehow suddenly every expense in your life has magically been transformed into a tax deductible expense. Folks, that does not exist. I don't care how many trusts you set up, how many LLCs or corporations, and if it's overseas or if it's in the United States, no matter how fancy it sounds, no matter how many other customers they have, and tell you how great it is that they're getting all these tax deductions, it is not legitimate. The IRS will catch up with you. You will get caught. And again, people go to prison for this all the time. And even if you don't go to prison, you pay large amounts of penalties and interest along with back taxes. Your personal living and family expenses simply are not deductible, period. Moving on. Bribes and kickbacks. The government does not want to encourage people to pay bribes and kickbacks, and so they are not tax deductible. Same way with fines and penalties. You should not get a tax deduction because you did something wrong and had to pay a fine or penalty, so they are not deductible. Club dues. So this is a big one. Doesn't matter what kind of club it is, business clubs, social, sporting, airline, and hotel clubs. And I can hear you already, but Tom, my country club is where I do all my best business. I take my customers and my potential customers, and we play golf and we have dinner. And so I need to be able to deduct those. Well, sorry, the dues are not deductible. Now, if you take them for dinner, we'll talk about meals later. You may be able to deduct some of that, but just your dues for belonging to any of these clubs, or the airline and the hotel clubs. You say, well, when I'm traveling and I need a quiet place to go make phone calls and do my work, and so I pay several $100s a year to belong to the airline club so I can go in there and have some peace and quiet. That's great. That might be a good thing for you to do, but that is not tax deductible. So club dues, not tax deductible. Entertainment, not deductible. Used to be able to deduct part or all of it, but no longer can you deduct any type of entertainment. Political contributions, not deductible, and similarly, lobbying expenses are not tax deductible. Other expenses that you have, such as meals, may be limited as well. Now, you generally can deduct business expenses even if they exceed your income. So you have a loss. And this is called a net operating loss, or NOL. And NOLs can be carried forward indefinitely, but not carried backwards. So it used to be you could carry them back or forward. Now you can only carry them forward, and you can carry them forward indefinitely. Meaning, if you have a loss in this year and you have a gain next year, then you can offset a large part of that gain with the loss from the previous year. Now, when they are carried forward, they can only be used to offset 80% of your current year taxable income. Again, that used to be 100%, but it is now only 80% of your current year income that you can carry forward a loss from a previous year in order to offset. Even though you can have a net operating loss, those losses might be limited by the at-risk rules or the passive loss rules or the hobby loss rules. We talked about the hobby loss rules in video 1 of part 2, so we're not going to go over those again, but we will talk about the at-risk limits and the passive loss rules. So the at-risk rules, what these rules are saying, the basic idea here is that you must have invested money or other property, or have money or property at risk of loss in order to take tax losses. So you can only take losses for tax purposes to the extent that you have some type of money or property at risk, either money or property that you have already invested, or money or property that you could lose, for instance, if there's a loan that is not paid back. So you have to have money or property that you could lose if this business does not work out. You can only deduct your losses to the extent that you have that money at risk. And these rules apply to individuals, so that would include partners and S Corp shareholders, estates, trusts, and certain closely held C Corps. And a closely held C Corp is any C Corp if any time during the last half of the tax year, more than half of the value of its outstanding stock is owned by 5 or fewer individuals. That's what a closely held C Corp is. So individuals, estates, trusts, and closely held C Corps are subject to these at-risk rules. You treat any loss that's disallowed because of these rules as a deduction for the same activity in the next year. So if it's not allowed this year, then you can use that loss for next year, as long as next year you've either have a profit or you have amounts at risk. If your losses are allowed, then they are subject to recapture in later years if your amount at risk is reduced below zero. So let's say this year you've got amounts at risk, and so you have a loss, and you take that loss, and that's perfectly fine. You can do that. You can have that tax loss. But now, let's say in a future year, let's say next year, you have a loss and there's more loss than amount that you have at risk. You could have to recapture some of those losses that you took the previous year, now that you have amounts that are not at risk. So it's similar to the depreciation recapture that we talked about before. What amounts are considered at risk? Well, first of all, and most straightforward, the money and adjusted basis of property that you contribute to the activity. So you've invested money or property in the activity, those amounts are at risk. Amounts that you borrow for use in the activity may be considered at risk if you are personally liable for the repayment or you pledge property as security for the loan. And the property that you're pledging in this case is property other than that used in the activity. And that loan must not be from a person who also has an interest in the activity or someone related to a person who has an interest in that activity. So the loan has to be from an institution. It could be from a bank, or it could be from an individual person or other organization, as long as that person or organization does not have an interest in the activity themselves. And then the last point you can see there is qualified non-recourse financing of real estate. So that can also be considered at risk. So these are amounts that are borrowed from a traditional lender like a bank, and they are secured by real property that is used in the activity. So in other words, you've got a partnership, let's say, and there is a building that is owned by the partnership, and the partnership goes out and gets a loan from a bank on that building, and the building is used as collateral for the loan. So if the loan is not paid, the bank is going to take the building. So that would be considered qualified non-recourse financing, since the partners do have something to lose. They've got this building that they own jointly as partners in the partnership, and if the partnership doesn't pay the loan back, then they are all going to lose that building. So they've got an amount at risk. So just remember that if you think about it, you have to invest the money, or you got to be personally liable for a loan, or you have to have property that you own that is at risk of being lost if the loan is not paid back in order to have money at risk. Next are the passive activity loss rules. We talked about this briefly in part 1, so let's talk about it in a little bit more in depth here. You cannot deduct losses from passive activities in excess of income from passive activities. So if you've got one or more passive activities that have a gain for the year, that have positive income for the year, then you can use losses from passive activities to offset those gains. But if your losses from passive activities exceed your gains from passive activities, you cannot deduct that excess loss. So that's what a passive activity loss is. So what is a passive activity? It is a trade or business in which you do not materially participate. We're going to talk about what that means on the next slide. Also, it is a rental activity, even if you do materially participate, unless you are a real estate professional. So we talked actually in the last part 1, about being a real estate professional. So we're not going to talk specifically about that again. But if you're not a real estate professional, then passive losses from rental activities are considered passive activity losses, even if you materially participate. And if you go back to part 1, we talk about this, and there's a $25,000 exception for certain individuals. And so you can get into all of those rules. Those tend to get tested more in part 1, but you will want to refamiliarize yourself with them for part 2 as well. Any unused passive losses can be carried forward to future years. So this is similar to the other losses we've talked about. You have a passive loss you can't use this year, you can carry it forward to next year, the year after, etc., to offset passive gains that you may have in those years. And you have to apply the at-risk rules before applying the passive activity loss rules. So we already covered the at-risk rules. So if you go through the at-risk rules and you find out, nope, we don't have amounts at risk, then you can just stop. You don't even have to worry about the passive activity loss rules because you're not eligible. If you don't have amounts at risk, then you cannot deduct the losses, whether they're active or passive or whatever. It does not matter. So now let's talk about material participation. What does it mean? Well, there are several different ways that a taxpayer can be considered to materially participate. And obviously what this means is if you materially participate, then it is not a passive activity, and so it is not subject to these passive activity loss rules. So the first way, and probably the most straightforward way, is that you participated in the activity for more than 500 hours. So in other words, you put more than 500 hours of work for the year into the activity. If you did that, then you materially participated. It is not a passive activity. Another way, if your participation was substantially all the participation of everyone, including non-owners, so that would include employees or contractors or anybody else that may have worked in the activity. So if your participation as the owner was basically all of the work that was done, there was really nobody else doing anything, whether they're owners or non-owners, you were pretty much doing everything, even if it wasn't 500 hours, then that would be considered material participation. The next way you can materially participate is if you participated more than 100 hours, and that was at least as much that anybody else participated. So here you could have other people participating as well, but as long as you were participating as much, at least as much as anybody else was, and that was more than 100 hours, you are considered to have materially participated. Next, the activity is a significant participation activity, and you participated in all significant participation activities for more than 500 hours. So what's a significant participation activity? It's any trade or business in which you participated for more than 100 hours and you did not meet any of the other tests. So let's say you've got several businesses that you work in. Let's say you've got 3 different businesses that you work in, and you put more than 100 hours into each of those businesses. So let's say one of those businesses you put in 150 hours, and the other 2 businesses you put in 200 hours each. So that's a total of 550 hours. So you met the 500-hour rule. You did at least 100 hours in each activity, so you're good there. And let's just say you did not meet any of the other tests. So in that case, you would qualify under this particular test, the significant participation activity test. There are other ways that you can be considered to materially participate. If you materially participated in the activity, according to any of the other tests, for any 5 of the preceding 10 years. So maybe you didn't qualify this year. You didn't meet any of the tests this year or even last year. But if you did meet any of the tests in 5 of the preceding 10 years, then you can consider yourself to have participated in this year. The next one is if the activity is a personal service activity and you materially participated for any 3 preceding tax years. So this is not 3 of the last 10. This is any 3 preceding tax years. So the examples of a personal service activity are health, law, engineering, accounting, actuarial, performing arts, consulting. If you have that type of thing, this is intended for retired partners or shareholders. So let's say you're a partner in a law firm and you have retired, but you're still a partner. Well, as long as you did materially participate in at least 3 years in the past, then this will still be considered a material participation activity for you. And then the last one is the facts and circumstances test. So this is the one, as you can see, it's based on all the facts and circumstances. You participated in the activity on a regular, continuous, and substantial basis, and you participated for more than 100 hours. And you cannot count management hours unless no one else is being paid to manage it, and no one else spent more hours on management than you did. So this is just, you don't meet any of the other tests, but you really feel like, hey, I put a lot of time and effort into this, and this should count for me. So as long as you do have more than 100 hours and you can convince the IRS that you participated in the activity on a regular, continuous, and substantial basis, then you could potentially call that material participation. Of course, you're going to need to be prepared to prove your case to the IRS. So you want to document. Moving on to specific types of deductions. First, we will talk about bad debts. You have a bad debt if you cannot collect money that is owed to you, and you can only deduct it if you already included the amount in income. So let's look at an example. A cash basis business bills a client for services rendered, and the client does not pay for more than a year. Efforts to collect are unsuccessful, and the client cannot be located. Since the amount was never included in the cash basis business's income, it cannot be deducted as a bad debt. Example 2. Same facts as example 1, except the business uses the accrual method, recording the income at the time of billing. The bad debt can be deducted. So this is the difference in cash and accrual. Cash, you never recorded that income, and so you cannot write off the bad debt. With accrual, you did record the income, so you can write off the bad debt. Now, I can hear an objection, and that is, well, but I did this service. I put all my time into it. My time is worth something. I should be able to write that off. But unfortunately, the IRS does not see it that way. This is similar to the charitable contribution rules, where people say they donate their time to an organization for free. So, say they're an attorney and they do legal work for a not for profit and they don't bill for that. They do that for free. And they say, well, that's my time and effort, and I bill at $200 an hour. I ought to be able to deduct $200 an hour for the time that I spent working for that charitable organization. Well, maybe you've got an argument, but the IRS doesn't buy it, and you cannot deduct that for tax purposes. Same concept here. Even though you put your time in, you didn't ever actually record any income from that, so you cannot deduct that. Now, obviously, if you're paying yourself a salary, your salary is still deductible. If you have a product that was sold to the client and then the client never paid for it, you would be able to deduct your cost as cost of goods sold for that product, but you cannot deduct just your time that you put into it. There are different types of business bad debts. First is credit sales. That's what we just talked about. You make a sale to a customer on credit. You're an accrual basis taxpayer, so you recognize the income. So that can be a business bad debt. Also, there are loans that have been made to clients and suppliers. As long as it is a business loan, that can be a bad debt. Debts of an insolvent partner that you paid. So you've got two or more partners. One of the partners does not pay their portion of a debt, and that partner is insolvent. And so the other partner or partners step in and pay that debt on the other partner's behalf. That is a bad debt. And then a business loan guarantee. So you guarantee a business loan and then the other party defaults and you have to make good on that. That can be deductible if certain criteria are met. You don't need to worry about those criteria for the EA exam. Just know that if you guaranteed a business loan and then have to make good on that, that can be a type of bad debt. Loan or capital contribution. So you cannot claim a bad debt deduction for a loan to a corporation if, based on the facts and circumstances, the loan is actually a contribution to capital. So you could have, let's say your business is a shareholder in another business. The amounts that you are putting there, if you're calling it a loan, but the IRS looks at it and says, no, that's not really a loan. That was just a contribution to capital. Then you're not going to be able to deduct that. So this is why, one of the reasons why it is so important when you are doing business with a related party. And if you are investing in a corporation, that corporation is a related party to you. If you are having any type of relationship, transactions, loans with that related party, then you want to document it. You want to have a loan agreement in place with a market interest rate, and all of the parties need to follow the terms of that loan agreement. You need to make sure you've actually got a loan. So it needs to look like a loan. That's called the form. And it actually needs to be a loan. That's called the substance. So you've got substance of transaction and you have the form of the transaction, which is what the transaction looks like. When you are dealing with anything with related parties, you want to make sure you have both substance and form. So you want to have whatever contracts or agreements or documentation that you would have if you were dealing with a third party. You want to have those when you're dealing with a related party, and you want the actual economic substance of the transaction to be legit. And so that's what this is talking about. Next, we need to know, when does a debt become worthless? And the answer is when there is no longer any chance the amount owed will be paid, and you must make reasonable attempts to collect. So you have to be able to show the IRS not just that, well, we don't think we're going to get our money back. It's not likely that we're going to get our money back, but you want to be able to show that you're not getting your money back. There's no chance that you are getting it and that you've made reasonable attempts to collect. So a very straightforward way would be the person owes you money, they file bankruptcy, you put in your claim with the bankruptcy court, and now the case is over and the bankruptcy court judge decided you don't get anything. You're too far down on the totem pole. There's too much other debt that has precedence over you. And so you're not getting anything. Well, obviously, you're not going to get paid for that. And you can go ahead and write off that debt. Now, it doesn't have to be that straightforward, but you are just going to be able to have some sort of proof that you've tried and tried. In that example we used earlier, the client had disappeared. We couldn't even find them anymore. And so if you can show that you've made those efforts and that you've tried to find them and you can't, and you can document all that, those would be the types of cases where you can show, hey, we're not getting our money back. Now, there are a couple of different methods of deducting bad debts. And the one that's most common and the most likely going to use is called the specific charge-off method. And that means you deduct specific bad debts that become partially or wholly worthless during the year. And you must generally deduct it in the year it becomes worthless. So this is as soon as you realize, hey, we're never getting this money back again, then that's when it becomes worthless. And then you write off that specific debt. There is something called the non-accrual experience method. So you're just going to want to know that it exists. You don't have to know all the ins and outs. This is for certain accrual basis taxpayers. And this is only for those that are they're in the service industries, accounting, law, architecture, etc. And they have to be smaller than that $29 million average annual revenue figure that we've seen several times. And they have to have an applicable financial statement. So this is for law firms, accounting firms, architecture firms, etc., that are less than the 29 million average of revenue. They have an audited financial statement. They can use this non-accrual experience method. And all this means is they provide their services and they bill their clients, and they know based on experience that some percentage of that is going to not be collectible. They don't know which clients are not going to pay, but they know that there are going to be some clients along the way who are not going to pay. So let's say it's just making up a number that's 3%. Historically, 3% of their billings never get paid. Well, they can go ahead and deduct that 3%, even though they can't point to a specific invoice that wasn't paid. So again, maybe there's one question on this. Just know that it exists, that you've got two methods, specific charge-off and non-accrual experience method, and then the general outline of how the non-accrual experience method works. Interest deductions. You can deduct interest on a debt only if you meet all of the following requirements. You are legally liable on that debt. Both you and the lender intend that the debt be repaid, and you and the lender have a true debtor-creditor relationship. And so these last two are really getting into related party or friend type of loans. So it has to be a legitimate loan. You and the lender both intend that the debt be repaid. So it's not a, here, I'm going to lend you some money, wink, wink, and you're actually giving that person, say a family member, the money. It has to be a legitimate loan. You have to have this true debtor-creditor relationship. And this gets back to, it is best to have this in writing with a market interest rate and all of that to be able to prove that, yep, this is a true debt. And then capitalized interest, and you're going to see this on several of the things we're going to talk about. It could be subject to uniform capitalization rules. So remember, we talked about how for inventory, certain businesses have to capitalize costs into their inventory rather than deducting them currently. So interest is one of those that could be subject to uniform capitalization. There is this 163J limitation on interest. So this is for large businesses with more than $29 million in average annual gross receipts. They are limited as to how much interest they can deduct, and also tax shelters are limited regardless of their gross receipts. And remember, you don't have to understand exactly what qualifies as a tax shelter. If it's on the exam, they will tell you that it is a tax shelter. So just know that tax shelters and these large businesses have this 163J interest limitation. Their interest is limited to the sum of these things: their business interest income, 30% of adjusted taxable income, and their floor plan financing interest. Again, you don't need to know the details of that. Just remember they have this 163J limitation, and it is the sum of these three things. That's all you're going to have to know for the exam. You're not going to have to compute it or anything like that. If they ask a question about it at all, it will just be one testing your general knowledge that this exists. Any non-deductible amounts under this limitation can be carried forward, and you use this Form 8990 to show those carry forwards. Taxes. You can deduct various federal, state, and local and foreign taxes as long as they are directly attributable to your trade or business. They're only deductible in the year paid, even if you are on the accrual basis. So for taxes, even if you say, well, I accrued the tax this year, even though I didn't pay it until next year, normally that would be an expense. But for tax purposes, you cannot deduct it until you actually pay the taxes. Some of the taxes are subject to uniform capitalization. And if you receive a refund of taxes previously deducted, you must include the refund in income. So some examples of deductible taxes: real estate taxes, personal property taxes, employment taxes. So that's the employer's share, Social Security and Medicare that we've talked about, unemployment taxes, federal and state excise taxes and fuel taxes, state and local income taxes, but not federal income tax. So remember, federal income tax is not a deduction for federal income tax purposes. And franchise taxes is another example. Sales tax is deductible as part of the item or service purchased if it's expensed or capitalized as part of the cost. So if you go to the store and you buy some office supplies, obviously there's going to be sales tax on that. You just deduct that as part of the office supplies. Or as we talked about when we talked about depreciation, if you buy a larger item, like you buy a delivery truck and you're charged sales tax, then the sales tax just becomes part of the basis of the delivery truck, and then you deduct that as depreciation over the recovery period of that truck. Insurance. You can generally deduct the cost of insurance related to your business. So these are examples of the deductible types of insurance. I'm not going to read all of them to you, but these are all your standard types of insurance that you would think about a business having. It does include life insurance on employees, as long as you or your business are not the beneficiary of the life insurance, which will lead us to another conversation, which is insurance that you cannot deduct. So self-insurance reserve funds set up to form a reserve for possible future losses. So you might, as a business practice in your business, set up a fund for self-insurance. You might say, hey, just in case we have a loss in the future, we're going to set some money aside. Maybe we'll put it into a separate bank account. And then if we have a loss, we can use that money to pay for that loss. That might be a good thing to do, a good business practice, but you cannot deduct those amounts that you set aside into that special bank account. Now, when you actually have a loss, then that loss may be deductible. depending on the circumstances. But just setting the money aside is not deductible. Disability insurance that covers lost earnings is not deductible expense. Life insurance, as we already said, if you or your business are the beneficiary, then you cannot deduct the cost of the life insurance. And similarly, insurance to secure a loan. So sometimes the bank will be afraid that you, as the main guarantor of the loan, might die and that they won't get their money back. And so they might require you to get a life insurance policy that will pay off the loan in the case of your death. So the amount that you pay for that policy would not be deductible. And then the reminder that some insurance costs could be subject to uniform capitalization. Next, rent. So rent for business property is deductible. If it's paid to a related party, it must be at market rates. So we've talked about this several times. You have a related party rental agreement. Make sure you have a written rental agreement, that it is at market rates, and that both sides of the party actually follow that rental agreement. So it needs to be, again, substance and form. You've got the form by having the written agreement in place, and then the substance is that both parties follow the terms of that agreement. For cash basis taxpayers, advance rent can be deducted for amounts up to 12 months in advance. Any additional is capitalized as prepaid rent and deducted in the following year. So we talked about this when we talked about accounting methods. We used prepaid insurance as our example then, but the same thing applies to any other prepaid expense, including rent. You can only deduct it. If you're a cash basis taxpayer, you can only deduct it for up to 12 months. So even though you paid it all this year, if you paid 3 years of rent in advance, you only can deduct 1 year this year, then you can deduct another next year and another the year after. And then rent could also be subject to UNICAP. Home office deduction, we did cover this in part 1. Going to go over it again briefly here. You can take a deduction for the use of part of your home as long as that part is used regularly and exclusively for business. So, for example, you've got an extra room that you use to run your business. It must be your principal place of business or the only place where administrative and management activities can be performed. So you might actually do your work somewhere else. Let's say you are a doctor and you actually do your work mostly at a hospital, but you don't, not an employee of the hospital, you're your own business, and you see patients at the hospital, but the only place you have to do your paperwork and your administrative work is a home office. So you can go ahead and make the deduction as long as you meet all of the other rules. You can own or rent the home. Either way, you can take the home office deduction, but you cannot do it as an employee. So this has to be as an owner of your business, not as an employee of the business. So you're self-employed, you can take the home office deduction, but not if you are an employee. There are 2 different methods, the simplified method and the regular method. Simplified method is $5 per square foot for the area used regularly and exclusively for business, with a maximum of 300 feet. So the maximum deduction each year is $1,500. The regular method is more complicated and requires more paperwork and documentation, but can result in a larger deduction than $1,500. So here, the deductions are based on the percentage of the home devoted to business use, usually based on the square feet. So you say, okay, if you've got a 2,000 square foot home and you use 200 square feet exclusively for your business, then you can take 10% of the relevant expenses for your home office deduction. So you could take 10% of your mortgage interest. That's your mortgage payment, your mortgage interest, of your homeowner's insurance, of your utilities, repairs, maintenance, depreciation, and rent. So if you don't own but you rent, then you could take, in our example, 10% of your rent. So take the square feet that you use for business, exclusively and regularly used for business, divided by your total square feet of living space, and that will give you the percentage that you can use to deduct those things. The energy efficient commercial buildings deduction, and this is one that was increased and expanded in 2023. So it existed before, but now it is made so that more businesses qualify. So building owners who place into service energy efficient commercial building property, EECBP, or energy efficient building retrofit property, EEBRP, may be able to claim a deduction. You don't need to know all the specifics of exactly what that means. If they ask a question on the exam, they will tell you that it is one of those two categories. This is available to owners of qualified commercial buildings. Again, you don't have to know what it takes to be qualified. Just know that it has to be a qualified commercial building. And designers of these types of property that is installed in buildings owned by certain tax-exempt entities. So those are the two types of taxpayers to whom this is available. The deduction is equal to the lesser of the cost of the installed property or the savings per square foot. And then you have this calculation here to figure out your savings per square foot. I would not worry about this calculation. Maybe you want to remember that the maximum is $1 per square foot for a building with 50% energy savings. You might remember that it is that maximum of $1, but you don't need to know exactly how to do the calculation. So it's the lesser of the cost of the installed property or the savings per square foot up to that maximum of $1 per square foot. Business, travel, and meals. We're going to have several slides on this because this is an area that the IRS realizes is subject to abuse. So you need to make sure you follow the rules and that you document. So first of all, the business travel and meal expenses must be ordinary and necessary expenses incurred while carrying on a trade or business. Now, that is true of all of the expenses that we're talking about. Remember, any expense we have has to be ordinary and necessary, and it has to be incurred while carrying on a trade or business. We're just reminding you here that this applies even to business travel and meals. So let's be honest here. What they don't want is people taking a family vacation and deducting it as a business expense, or people having a nice personal meal out at an expensive restaurant and deducting it as a business expense. So they're wanting to make sure it is an actual business expense. That's what we're talking about. So you must have receipts or records substantiating the amount that you paid, the time and place. So when was this and where was this? What was the business purpose of this travel or meal expense? And what were the identity and business relationship for the other people if you are talking about a meal? So you need to actually put, like, make a note. Maybe it's on the receipt of had dinner with Mary Smith and John Doe of XYZ Company to discuss whatever. So you want to be able to document who you met with, why you met with them, where, when, etc. And you want to keep copies of that so you can show the IRS that this was a legitimate expense. Per diem rates, so that means per day, per diem rates can be used for meals by both self-employed taxpayers and employers. But if you use per diems, it has to be the same or less than the federal per diem rates. And we're going to talk about that a little bit more here in a little bit. Per diem rates for lodging can be used by employers only. So if you're self-employed, you cannot use a per diem rate for lodging. You have to use your actual expenses for your hotel or whatever. Except for lodging, any expenses that you have that are under $75 do not require a receipt. So you can have meals or other expenses that are under $75 that do not require a receipt. However, remember, if you are talking about a meal, you do have to be able to establish the time and place. So you'd want to have some sort of record for that. For transportation expenses, if no receipt is readily available, then you don't need one. So maybe you took a taxi cab, paid cash, didn't get a receipt. That's okay. You can go ahead and deduct that as long as you can establish it was for a business purpose. For an employer, so you've got an employer and an employee relationship, these expenses can be reimbursed as part of either an accountable plan or a non-accountable plan. So an accountable plan means the employee must account for and produce receipts for expenses in order to be reimbursed. Any excess reimbursement must be returned by the employee within a reasonable time. So sometimes there are companies who say, hey, we're going to send you on a business trip. We know you're going to have out-of-pocket expenses, so we're going to give you an advance, some money to help pay those expenses. Well, if they do that, and then the employee ends up having fewer expenses than the amount of that advance, then the employee has to pay the advance back. So they think that that makes sense. If you have one of these accountable plans, so this is in your typical company, you're working for a company, you travel for business, you then have to fill out an expense report for your employer, and you include all of your receipts, and then you turn that expense report in, and your employer reimburses you. So that's a typical expense reimbursement that you have with companies. So in that case, there's nothing on your W-2 or anything else because you just had an expense and they just reimbursed you. That's not included as part of your salary. And then the business can, of course, write off those expenses as business expenses. So that's an accountable plan. You could also have a non-accountable plan, which means that the employee is not producing any type of receipts or giving you any type of documentation at all about those expenses. And so in that case, though, that is just considered wages. So this does happen sometimes with like salespeople. They are W-2 employees, but they're out in the field all month. They're out Monday through Friday. They're out on the road traveling to their different customers. They're staying in hotels. They are having meals. They may have dry cleaning, all the normal travel expenses, but the company just gives them a flat amount. They might just say, hey, we know you're going to have expenses. You're out there doing this. We're going to give you $2,000 a month, and you just use that how you want to pay for hotels and meals, etc. That's fine. They can do that. However, that's just going to be considered salary. Now, it'll show up as a separate line on their W-2 that it'll say it is expenses from a non-accountable plan, but it will be included in their gross wages. So that is a non-accountable plan. Meals. We'll talk about meals. They are usually deductible if incurred while traveling on business or provided to a client, employee, vendor, etc. However, they are limited to 50% of the cost of the meal, and that includes the tax, tip, any delivery or service charges. So this is one of those book to tax differences that you will find very commonly. On the company's books, under generally accepted accounting principles, they can deduct the full cost of business meals. That's fine, but for tax purposes, you can only deduct half of it. So you will see that there will be a book to tax difference for that 50% difference. Now, there are some special employees like truck drivers, bus drivers, these drivers who are subject to hours and service limits where the government says you can only work so many hours in a day, so many hours in a week. If you have drivers that are subject to those limits, or other employees could be pilots that are subject to those limits, then you can deduct 80% of their meals, but it's 50% for everyone else. Travel and lodging expenses are deductible for temporary travel away from home for business. So it has to be all of those things. Temporary, So this is not where you're sending the person, you're moving the person to a different city and you're paying for their apartment from now on. That would be wages. But if it's just a temporary thing where they're just going to be there temporarily, it could still be an apartment, but you're saying, okay, we're going to send you there for a year and we'll pay for your apartment while you're there. That's fine. That's temporary. And it has to be travel away from home for business. So we'll talk a little bit more about that. Now, when we say it has to be away from home, it could include lodging locally for meetings and conferences that require the employee to be there overnight. So this could be like a company's having a big meeting for all of their employees or a big sales meeting, and all the employees from all over the country are coming to the home office and they are going to have a meeting there at the home office or at a place near the home office. So obviously, the employees who are coming from other cities, then their lodging is no problem. That is deductible. But what about the people who actually live in that city where the home office is? Well, if those employees are required to stay at the hotel along with the employees from out of town, then you can go ahead and deduct their lodging as well. That's what this is saying. When we talk about your home, we mean your normal place of work, regardless of where the employee lives. But it's usually people are living and working in their same place, but they might drive a while. They might have a pretty good commute in order to get to work. So the home here means your normal place of work. So deductible travel expenses include transportation, getting to where you're going, lodging once you get there, meals, subject to that 50% limit, tips, dry cleaning, laundry, etc. All of those type of expenses are deductible. Per diem, so we touched on this earlier. An employer with an accountable plan can reimburse an employee for expenses based on travel days, miles, or some other fixed allowance. So there are federal mileage, meal, and travel rates that are published. You can go out there, search for them, and find out what those rates are. You can pay your employees, as long as you have an accountable plan, you can reimburse them based on these federal per diem rates or any amount less than the federal per diem rate, but the maximum you can do is the federal per diem rate. You can reimburse them based on those rates and deduct that. But the employee must still establish all the other elements of the expense, such as the time, place, and business purpose. And this includes mileage, and the business mileage rate for 2023 is 65.5 cents per mile. And again, that's the maximum that you can use. Business gifts, you can deduct business gifts up to $25 per person per year. And I know a lot of people think that that's not very much, and you might be right, but that is the amount. It's $25 per person per year. That is tax deductible for business gifts. Small giveaway type items that cost $4 or less are not included in that total. So if you've got pens or something with your company name on them that you are giving away, then you wouldn't have to include that in the $25 total. Charitable contributions. We talked about this in part one. Of course, charitable contributions can be deductible by individuals in certain cases, but they're not generally allowed as business expenses, except for C corporations may be able to deduct charitable contributions. So C corporations are separate taxpayers, so they may be able to deduct charitable contributions. We'll get more into that in the C Corp video. S Corps and partnerships. Here's the way it works for them. Let's say the business makes a charitable contribution, which they can do, but the business does not deduct them. So on page 1 of the S Corp or partnership return, where it shows all of your revenue and expenses, you would not include charitable contributions in those deductions that are there on page 1. Instead, the S Corp or partnership puts those on Schedule K, and then reports them out on Schedule K1 to the partners or shareholders. And then the partner or the shareholder, they can deduct those on their Form 1040 as long as they meet all of the normal rules and as long as they are, in fact, itemizing deductions. So the business does not deduct them, but they report them out as what are called separately stated items. Charitable contributions are one of the separately stated items. It'll be on the K1 as a separately stated charitable contribution so that the individual partner or shareholder could use those on their tax return. And then if you're a sole proprietor, then you don't put the charitable contribution anywhere on your Schedule C. You just deduct it on Schedule A as you normally would as a charitable contribution, as long as you are itemizing deductions and as long as that is a legitimate charitable contribution deduction. Other business expenses. So we've talked about some specific business expenses that are more likely to be tested on the exam. But of course, there's lots of other things that could be deductible. And I've listed a bunch of them there on the slide: advertising, car and truck expenses, education and training, etc. All of those things, as long as they are ordinary and necessary business expenses used in a trade or business, so as long as they are legitimate business expenses, they can be deducted as well. So now let's talk specifically about compensation and fringe benefits. So salaries and wages that you pay to employees are, of course, generally deductible. Now, the compensation must be reasonable. We will discuss that in more detail when we cover each type of entity. So just know, again, it has to be an ordinary and necessary business expense. And so that means that the compensation you're paying must be ordinary and necessary. So it has to be reasonable compensation. When employing family members, compensation must be commensurate with the work performed. So again, this goes back to these related party transactions. It is perfectly fine to employ family members. There's nothing wrong with it. It is done every day all over the country. We've got lots and lots of businesses that are family businesses, and family members are employed. And of course, you can deduct their salary and wages just like you can deduct anybody else's salary and wages. But as you might imagine, this could be an area that is abused. And so you could be trying to create these tax deductions for salaries and wages for family members who really aren't doing anything or are hardly doing anything. So if you are paying family members, you just have to make sure that you are paying them a reasonable amount for work that is actually being performed. So you want to make sure to document the hours worked and the tasks performed. So you can't just say, well, yeah, they worked 2,000 hours for us this past year. Document like a time card, or you probably keep that in a computer, but it could be on a spreadsheet, could be manual, whatever, but you want to document that this person worked these hours and this is what they did, and then that their compensation is commensurate with that work and with that amount of work, and that you pay market rates. So what would you have paid a non-family member to do that work? You want to pay those same rates to your family members. Fringe benefits. A fringe benefit is a form of pay for performance of services that's in addition to money. So this is not outright salary like you would normally have. It is some other type of benefit that they are getting that is not money. Fringe benefits are taxable unless specifically excluded from income by law. So we're going to spend most of our time in this section talking about items that are specifically excluded from income by law. But you need to remember that the general rule, the default, is that fringe benefits are taxable. We're going to talk specifically about the ones that are excluded, but remember, if it's something else, then you should just assume that it is taxable, just like salary is taxable. The taxable portion of a fringe benefit is the value of the benefit less the amount the employee paid for it. So if the employee pays, let's say they pay a discounted amount for something, well, the taxable portion is that amount over what the employee actually paid. There are special rules for some fringe benefits for partners and partnerships and for greater than 2% owners of S corporations. So you want to keep that in mind, and we'll talk more about those in those specific videos. And then there is this general non-discrimination rule, which says that the fringe benefits must be offered to all employees to be deductible and to receive favored tax treatment. So it can't be something that just the higher ups get. The C-suite only gets these things, or the owners of the company who also happen to be employees get these things, but nobody else does. So it has to be benefits that are available to everyone. Cafeteria plans. So you want to be familiar with this concept. So this provides participants with an opportunity to receive qualified benefits on a pre-tax basis. So this is common in larger companies that will have benefit plans. And you can see there it includes an FSA, that's a flexible spending account. But the employees have a choice of several benefits, and then they pay their share on a pre-tax basis. So what a company might do is annually, if you've ever worked for these companies that provide, for instance, health insurance, then every year there'll be this time when you have to enroll. It's annual enrollment, and you have to choose your health insurance for the year and your other benefits. So what a cafeteria plan does is the company says, we are going to give you X amount of dollars per pay period to pay for your benefits, but we're going to let you pick and choose from a list which benefits you want. And then we're going to tell you each benefit costs this amount per pay period. So you take the amount of money that we're giving you per pay period and you allocate that however you want. So if you need health insurance, you choose health insurance. And if you need a flexible spending account, you choose that. If you want extra life insurance, then you choose life insurance. They can have a whole list of things that are available. You pick and choose what you want based on the number of dollars that they give you. That is a cafeteria plan, because it's like going to the cafeteria and you walk down the line and you pick and choose, hey, I'll have some of this and I'll have some of that, but no, I don't want that. And then you get to the end and you pay for whatever you have. That's what a cafeteria plan is here, except instead of picking food, you are picking the benefits that you want. Now, the plan does have to meet certain requirements, and there can only be certain benefits that are included as part of the plan, such as a 401k plan, health insurance, HSA, which is health savings account contributions, group life, disability insurance, adoption assistance, independent care insurance. Interestingly, a 403b plan, which is a savings or retirement plan for not-for-profits and governmental type agencies, is not included in a cafeteria plan, but the 401k plan is. Achievement awards, tangible personal property given to an employee as an award for either length of service or for safety. These awards are excluded from the employee's income, but it does not apply to cash, cash equivalents, gift cards, gift coupons, or most gift certificates. It also does not apply to vacations, meals, lodging, tickets to theater, sporting events, stocks, bonds, or other securities and similar items. So this is your typical gold watch that you get when you retire, or you get something because there were no accidents for the year, and so you're getting some sort of award for that for safety. These types of things, tangible personal property that is given to people, are excludable up to $1,600. It's limited to $400 if this is not part of a qualified written plan. Big companies are usually going to have a written plan that spells all this out and who's eligible and et cetera and so forth. So as long as you have one of those plans, it's $1,600. If you don't have one of those plans, it is limited to $400. Adoption assistance provided to employees is excluded from income. However, it has to meet very stringent non-discrimination tests. So in other words, this can't be adoption assistance that's only given to the owners or to the C-suite. It has to be available to all employees, but it is excluded from the employee's income as long as it meets these requirements. Athletic facilities. The value on an employee's use of an on-premises gym operated by the employer is excluded from income, but it only applies if that gym is not open to the public. So it has to be a private facility just for the use of the employees or maybe the employees' family members and not open to the general public. De minimis fringe benefits. A de minimis benefit is excluded from income. So de minimis means small. So this is any property or service you provided to an employee that has so little value that accounting for it would be unreasonable or administratively impracticable. But this never includes cash or cash equivalents, such as gift cards, gift certificates, use of a credit card, etc. Those, no matter how small they are, those are never considered de minimis fringe benefits. Examples of this would be occasional use of a copy machine for personal purposes, small holiday gifts, occasional parties that you might give for employees, occasional tickets to theater or sporting events. Do not have to include those in the employee's income. Dependent care assistance of up to $5,000 per employee can be provided and excluded. If the employee is married filing separate, they only get $2,500. The requirements here are basically the same as the tests that the employee would have to meet to claim the dependent care credit that we talked about in part one. But up to $5,000 of employer-provided dependent care assistance can be excluded. That's the number you will want to remember for the exam. Educational assistance, the number you will want to remember is $5,250, can be excluded. The exclusion includes graduate level courses. This includes all of these costs: tuition, books, equipment, and fees. However, it does not include costs for courses involving sports, games, or hobbies unless those are directly related to the business or required for a degree program. And it does not include costs for tools that the employee keeps at the end of the course, nor the cost for lodging, transportation, or meals. So this is just costs of the tuition books in the directly related expenses of the course. This exclusion also applies to amounts to pay off the employee's student loans. So you can pay off up to $5,250 per year of the employee's student loans in lieu of paying for their education. And educational assistance in excess of the $5,250 may be deductible as a working condition benefit that we will talk about later. Employee discounts. Discounts given to employees on property or services you offer to customers in the ordinary course of business are excludable. The employee must perform substantial services in the line of business for which the discount is given. This does not apply to discounts on real property or investments such as stocks and bonds. Excludable discounts on services are limited to 20% of the price charged to customers. So if you are a law firm and you are providing free law services for an employee, then only 20% of the amount that you would usually charge your clients is going to be excludable. That's what that is saying. Excludable discounts on merchandise are limited to the price charged to customers times the gross profit percentage. In other words, it's only your cost of that item that is excludable, not the full retail price of that item. Employee stock options. Under Section 83I, qualified employees who are granted stock options or restricted stock units, RSUs, and who later receive stock upon exercising the option or settlement of that RSU may elect to defer recognition of income for up to 5 years. This must be under a written plan wherein not less than 80% of employees are participating, and the deferral only applies to income tax, federal income tax, not to payroll taxes. So keep all of those things in mind. Section 83I, they can defer for up to 5 years, but it has to be available to at least 80% of employees, and it is only for income tax, not for employment taxes. Cell phones. Employer-provided cell phones are excludable as long as there is a non-compensatory business purpose for providing the phone. In other words, you're not providing the phone just as a perk to promote goodwill with employees or boost their morale or to attract prospective employees, but there's actually a business purpose for providing that phone. So examples of a legitimate business purpose would be a need to contact the employee at all times for emergencies, a requirement that the employee be available to speak with clients at times when the employee is away from the office, and the need to speak with clients located in other time zones at times outside the employee's normal workday. So they need to have a cell phone because before or after their work, they need to be able to be talking to clients who live in other time zones. And personal use of this phone is excludable as a de minimis fringe benefit. So you don't have to worry about pretending that your employees are not using this phone for personal purposes at all. As long as there is a legitimate business purpose for providing the phone, then they can use it for personal use as well, and that is excludable as a de minimis fringe benefit. Employer-provided vehicles. If you provide an employee with a company car or company vehicle, you must include in the employee's income the fair market value for their personal use of that vehicle. So the business use, of course, is fine, but to the extent that they have personal use, you have to include the value of that in their W-2. It's included as part of their income. There are a few different methods for determining that fair market value, and we will talk about each of these: the general valuation rule, the cents per mile rule, and the lease value rule. And then there is something called the commuting rule, and what that says is that commuting miles are personal. So the miles for getting from your home to your office, those are personal miles. Those are not considered business miles. So you need to make sure when you are figuring out the amount of personal miles that the employee has, that they are including in that commuting miles. So what needs to happen, no matter what method you're using to determine fair market value, the employee needs to be keeping track of their miles. How many personal miles and business miles are they using? And then they need to report that to the employer so that the employer can figure out the fair market value of the personal use. And so you need to make it clear to your employees that commuting miles need to be included in the personal miles. So let's start with the different ways of determining the fair market value. First is the general valuation rule. This says the fair market value of the personal use of the vehicle is the amount the employee would have paid to a third party to lease the same or similar vehicle on the same or comparable terms in the same geographic area where the employee uses the vehicle. So if the employee had to go out and get a lease on a car or a rental car for their personal use, how much would they have to pay? That's what this is saying. A comparable lease term would be the amount of time the vehicle is available for the employee's use, such as a 1-year period. And you determine this amount based on all the facts and circumstances. This rule in practice is not actually used very much because it's kind of squishy, if you will. It's hard to come up with a black and white answer because you have to try to match the term that the person is using the car and how much would you actually pay? And you have to go out and do some research and figure out how much you would actually pay in their geographic area to use that particular car for that particular period of time. And it takes actually a lot of work to try to figure this out and to be able to document this to the satisfaction of the IRS. So it's not actually used that much, but for purposes of the exam, you need to understand generally what it is, the general valuation rule. Next is the cents per mile rule. So this is much more common and much more popular. So here you multiply the employee's personal miles driven by the standard mileage rate, which changes every year. Sometimes it changes more than once a year. But for 2023, the rate was 65.5 cents for the entire year. This amount includes fuel. So if the employee purchases their own fuel, then you can reduce that 65.5 cent rate by up to 5.5 cents. So you can make it 60 cents a mile if the employee is buying their own gas. You can use this method, the cents per mile rule, if all of the following are true. First, the employer reasonably expects the vehicle to be regularly used in the trade or business throughout the calendar year. Second, the vehicle is actually driven for at least 10,000 miles during the year in total. If you own or lease the vehicle for only part of the year, then you reduce the requirement proportionally. So if you only actually have the vehicle for half the year, then it would be 5,000 miles, but you get the idea. 10,000 miles on an annual basis, at least. And the value of the vehicle when it is first made available to the employee is no more than $60,800. So you can't have super expensive cars, can't be providing them a fancy Porsche or something. It has to be $60,800 or less in order to use the cents per mile rule. Lease valuation rule. Under this rule, you determine the value of the automobile you provide using its annual lease value, or ALV, based on its fair market value on the first day it is available to the employee. And this annual lease value is determined by some tables that are provided by the IRS, which is based on a 4-year lease term. You then multiply this annual lease value that's on this table that we're going to look at here in a minute by the percentage of personal miles driven. And that gives you the fair market value of the personal use of the vehicle. If the vehicle remains in service after 4 years, then you recompute the annual lease value based on the car's current fair market value. So when they first get the car, you're going to use it based on its value at that time. If they're still using it after 4 years, then you're going to go back and say, okay, how much is that same car worth now? And you're going to get a new value from the table. It's going to be a lower value that you're now going to get from the value from that table, because the car is obviously worth less 4 years later than it was when it was new. So here's what the table looks like. So you can look here. This is the fair market value of the vehicle. This is the annual lease value that you are going to use. So let's just say you had a vehicle that was worth $30,000. The annual lease value would be $8,250. So you would multiply that $8,250 by the percentage of personal use for the employee. So again, the employee is keeping track of their personal miles, including their commuting miles and their business miles, and they were reporting that to you as the employer. You compute a percentage of their personal use, you multiply that by $8,250, and you include that in their W-2 for the year. That's how this works. This table only goes up to $59,900. So if you have a car that costs $60,000 or more, you can still use the annual lease value method, but you use this formula instead of using the table. You take the fair market value of the automobile times 0.25, so that's 25%, and then you add $500. So if you have an $80,000 automobile, 25% of that is $20,000 plus $500. So your annual lease value would be $20,500, and that's what you would multiply by the personal use percentage in order to get the amount that is included on the employee's W-2. For the lease valuation rule, the annual lease value includes maintenance and insurance, but the annual lease value cannot be reduced even if the employer does not pay for those items. So if the employer doesn't pay for maintenance insurance, sorry, but the employee is still going to have just as much included in their W-2. However, the annual lease value does not include fuel. So if the employer pays for fuel, it has to be added to the annual lease value, and you can use 5.5 cents per mile for that in 2023. Certain special purpose vehicles are automatically excluded from income. So you don't have to worry about any of those rules that we just talked about for these special types of vehicles. And it's because their utility for personal use is limited. So examples would be marked police, fire, and public safety vehicles, hearses, delivery trucks that meet certain requirements. They only have a driver's seat, or they're refrigerated, or they're trucks with a loaded weight of over 14,000 pounds. Any types of those delivery trucks would be excluded. Moving vans, school buses and passenger buses, tractors, and other special purpose farm vehicles. So if any of those type of vehicles, you don't have to include any amount in the employee's pay for personal use. Demonstrator cars. So this is for car dealers who their salespeople will often be able to get a demonstrator car that they can use for personal purposes. So in general, the use of a demonstrator car by a full-time auto salesperson qualifies as a working condition fringe benefit, which means it is excluded, but there must be restrictions on personal use and meet other criteria. So maybe they say you can use it to drive back and forth from work, but you can't use it for anything other than that. So as long as you meet the criteria, you don't have to know specifically what that is. Just know that if you have a demonstrator car for a full-time auto sales person and they meet the requirements, then those are generally going to be excluded. Group term life insurance. So the cost of up to $50,000 of group term life insurance on an employee is excludable from income. To figure the taxable amount for amounts greater than $50,000, there's an IRS table. So if you're getting more than $50,000, that part above $50,000 is taxable to the employee, and there's an IRS table that you used in order to figure that amount out. And you have to follow the 10 employee rule, which means the benefit is available either to all employees or to at least 10 employees that have coverage. Health benefits, the cost of employer-provided health coverage is excluded from income. So this is a very common fringe benefit that people have. The employer provides health insurance, or at least they provide an amount towards health insurance, and the employee can exclude that from income. So this includes health insurance, contributions to Archer MSAs, which are medical savings accounts, health savings accounts, COBRA premiums. So if you leave a job, you are often entitled to be able to keep getting health insurance after you leave. So usually you have to pay for it yourself. But if your employer agrees to provide some of those premiums for you, that would be included in this, and you would not have to include it in your income as the employee. It also includes health reimbursement arrangements and other health plans. It does not include the cost of long-term care insurance through a flexible spending arrangement. So it's for health insurance, not this long-term care insurance. Health savings accounts. So an HSA is an account an employee can use to pay for out-of-pocket medical expenses, including deductibles, co-pays, and co-insurance. So contributions by the employer are tax-free, and contributions made by the employee are done on a pre-tax basis, meaning they also escape income tax. So both employer and employee contributions are tax-free. Withdrawals are tax-free as long as they are used for qualified medical expenses. And any remaining funds after reaching age 65 can be treated like an IRA. So health savings accounts are great. You can put the money in there on a pre-tax basis, and that money can build up and build up and build up. You don't have to use it each year. And once you reach age 65, then you can be on Medicare, and you can treat any amount that's in your HSA just like you would treat an IRA. So you can use it as a retirement account at that point. Now, the HSA must be combined with a high deductible health plan, or HDHP. And in order to be a high deductible plan, it has to have a deductible of at least $1,500 for single coverage or $3,000 for family coverage. The maximum annual contributions for the employer-employee combined are there on the screen. So if you're under 55, it's $3,850 for self-only coverage, and it's $7,750 for family coverage. Once you're 55 or older, you can add $1,000 per year to those amounts. Lodging on your business premises. You can exclude the value of lodging you furnish to an employee if it meets the following tests. It is furnished on your business premises. It is furnished for the employer's convenience, and the employee must accept it as a condition of employment. And it does not apply if the employee could have chosen to get additional pay instead of the lodging. So an example might be, you've seen these self-storage lots. Sometimes these businesses want to have somebody there pretty much 24/7 in order to help customers that may have an issue, say in the middle of the night. So these self-storage lots might say to the manager when they hire them, like, hey, we're going to hire you, but part of the deal is you have to live on premises. We got a little apartment that's there above the office building, and you have to live there. And the employee says, okay, that's fine. That's good. That way I don't have to own a house or pay rent for an apartment. So I like that. That's nice. So in that case, as long as it's on the business premises and it is for the employer's convenience, then they can go ahead and deduct that, of course, and they can exclude that from the employee's wages. Obviously, if you give the employee the choice, either you can take the little apartment or we'll pay you more wages and you can live wherever you want. Well, at that point, it's obviously not necessary for the employee to be there. And so that would not count. And you would have to include it in their income. De minimis meals, again, small meals. So you can exclude any occasional meal you provide to an employee if it has so little value that accounting for it would be unreasonable or administratively impracticable. So this exclusion applies to, for example, the following types of items: coffee, donuts, bagels, soft drinks that you provide for employees. You can deduct those, don't have to include them in the employee's income. Occasional meals or meal money provided to enable an employee to work overtime. So, hey, look, we know you're having to work late tonight, so we're going to provide you a meal. If you're a tax person, during tax season, you work for, say, an accounting firm, this might apply to you. They might say, hey, it's tax season, you're working late, we're going to order pizza for everybody, or we're going to order sandwiches for everybody, or whatever. Those type of meals can be excluded from your income. And then occasional parties or picnics for employees and their guests. So you're having a nice little picnic for your employees and their families. And obviously that costs money. You can exclude that from the employee's income. You can also exclude meals provided at an on-premises facility, such as a cafeteria, if the annual revenue from that facility equal or exceeds its direct operating costs. In other words, if that cafeteria is at least breaking even or making money, then if you are providing employees with meals there occasionally, you can exclude those as well. So I think about like a hospital that has a cafeteria and that patients and their families might eat at the cafeteria and they pay money, obviously, but the employer decides that, hey, I'm going to go ahead and pay for your meal in the cafeteria because you had to work extra today, that can be excluded as well. Meals on your business premises. You can exclude the value of meals you furnish to an employee from the employee's wages if they meet the following tests. They are furnished on your business premises and they are furnished for your convenience. This is subject to something called the more than half rule. The convenience of the employer test only has to be met for more than half of the employees in order to exclude the meals for all the employees. So as long as you're doing this for the convenience of more than half of your employees, then you can exclude the meals for all employees that you provide on premises. So again, this could be, for instance, a cafeteria. So as long as you meet this test, you can exclude the value of those meals that are provided, even if that cafeteria does not meet or exceed its expenses. In other words, even if it's operating at a loss, you can still exclude those meals from the employee's pay as long as you meet these tests. But again, if the employee can choose to receive additional pay instead of the meal, then you can't really say it is necessary that they eat on premises. So therefore, you cannot exclude those meals if that is the case. Here are some examples of meals that can be excluded. Meals you furnish to a restaurant or other food service employee during or immediately before or after the employee's working hours. So you are a restaurant and you want to say, hey, as one of the perks of working here during your shift, we are going to provide you with a meal, or immediately after your shift, we're going to provide you with a meal. You can exclude that from their income. Meals you furnish during working hours so employee will be available for emergency calls during the meal period. In other words, hey, you are a doctor or a nurse and we need you here in case of an emergency, so we're going to provide you free meal in the cafeteria. You can exclude that from their income. Meals you furnish during working hours if the nature of your business restricts an employee to a short meal period. So they only get about a half an hour or 45 minutes. And it's not reasonable to expect they can go out and leave and get to a restaurant and order and eat and get back in that time frame. Then you can exclude those meals. Or meals you furnish during working hours if the employee couldn't otherwise get proper meals within a reasonable period of time. So maybe you're in some remote area and there is no restaurant within a reasonable distance that they could possibly get out and get back in time. You can exclude those meals. There are some meals that cannot be excluded. So these are meals after work hours unless it's immediately after. So again, you have that restaurant and the person comes in like on their day off or something and you provide them a free meal, that you would not be able to exclude from their income. You would have to include it. Any meals you furnish to promote goodwill, boost morale, or attract prospective employees. Meals furnished on non-work days or with lodging, if that lodging cannot be excluded. So if the lodging can be excluded, then you can exclude any meals that are also provided. But if it is lodging that you are providing that you cannot exclude from that employee's income, then you also cannot exclude the meals that are provided along with it. No additional cost services. A service that you provide to an employee, if it doesn't cause you to incur any substantial additional costs, can be excluded from the employee's income. The service must be offered to customers in the ordinary course of the line of business to which the employee works. And the no additional cost services are excess capacity services, such as airline, bus, or train tickets, hotel rooms, or telephone services provided free or at a reduced price. So you probably know that airline employees, such as flight attendants and others, they can fly for free. So they can go on standby, and as long as there is a seat available on that flight, then they can just jump on that flight and they can fly for free. And that is fine because otherwise the plane's just going to fly out of there with an empty seat anyway. So it doesn't really cost the airline anything else to have that employee there, at least nothing substantial. You could make an argument that it costs a little bit more fuel, but there's no substantial increase in the company's cost to have that person on that plane rather than an empty seat. Same with a bus or a train ticket or an extra hotel room. You're providing a hotel room for somebody. You would have had an empty hotel room anyway. So that can be excluded. So those types of no additional cost services do not have to be included in the employee's income. Retirement plan contributions are also generally deductible, not included in the employee's income. We will discuss those in a later video. Retirement planning services. This is retirement planning advice or information you provide to your employee or their spouse. It may be excluded if you maintain a qualified retirement plan. So this is typical. You've got like a 401k plan, and then whoever is providing the investment choices for the 401k plan, they may have representatives who will, for instance, come on site and they will provide retirement planning assistance to the employees. Or may not have to be on site. They might do it via phone call or whatever. But as long as they have a qualified retirement plan and they've got someone providing these type of retirement planning services, that is fine. You do not have to include that in the employee's income. But this exclusion does not apply to things like tax preparation, accounting, legal, or brokerage services. So if you're providing somebody to prepare the tax return of the employee, you would have to include the cost of that tax preparation in the employee's income. Transportation and commuting benefits. So de minimis transportation benefits can be excluded. So examples would be a local transportation fare that you give an employee because they are working overtime. So they have to work overtime. Maybe they're going to miss their normal bus or train. And so you pay for an Uber or a Lyft or a taxi cab so they can get home. You can exclude that. Local transportation fare provided on a regular or routine basis does not qualify for this exclusion. So this is the, hey, once in a while, because of unusual circumstances, we're doing this for you. You can exclude that. And you can exclude up to $21 per month for public transit passes, token, or fare cards that you provide at a discount or the reimbursement for one of those cards. So up to $21 a month just for normal commuting, you can exclude from their income. Qualified transportation benefits may also be excluded, and that includes a ride in a commuter highway vehicle, such as a van, between the employee's home and workplace. So sometimes companies will provide these vans where they pick up several employees and they drive them all into the office. So you can exclude that from the employee's income. Or a transit pass and qualified parking. So the maximum combined exclusion for the commuter highway vehicle and the transit pass is $300 per month. And then the maximum exclusion from the parking is also $300 a month. So it's $300 per month for the combination of the commuter highway vehicle and the transit pass, and it is $300 a month for the qualified parking. Tuition reduction. An educational organization can exclude the value of a qualified tuition reduction it provides an employee from their wages. So you've got say a college or university, and they allow an employee to take classes for free. You can exclude that from their wages. So undergraduate education qualifies for the exclusion as long as it is for a current employee, a retired or disabled former employee, or the widow or widower of either of those. Graduate education qualifies only if it is for a graduate student who performs teaching or research activities for the institution. So undergraduate is for any employee. Graduate is only for a graduate student who is also teaching or providing research activities for the institution. But that is a nice benefit for those who work for a college or university, that they can get an undergraduate education for free, and it is not included in their income. It is not taxable. Working condition benefits. So we've talked about this a couple of times. So this exclusion applies to property and services you provide to an employee so they can perform their job. Examples include the use of a car for business, a cell phone, and job-related education. It also applies to expense reimbursements. So we've already talked about some of those specifics, but this is where it's actually saying the part that you are including for business purposes, for instance, is excludable from income. And remember, we said education, you're limited to $5,250 a year of reimbursement. You could have more than that if it falls into this working condition benefit category. It applies to the extent that the cost of the property or services would be allowable as a business expense or depreciation expense if the employee had to pay for it themselves. So that's when this applies. The employee must account for the business use and meet any substantiation requirements. So the employee does have to show that, yes, this actually is for business purposes, just like they would with any other type of business expense. So that is working condition fringe benefits. Now let's move on to talk about business credits. The general business credit. The general business credit consists of your carry forward of business credits from prior years plus the total of your current year business credits. And the general business credit is a whole bunch of different credits that are all combined into this one GBC, general business credit, and they were reported on Form 3800. In addition, each individual credit has its own form to complete. So when you have these, you're going to complete a form for whichever individual credit you have, and you're going to complete this Form 3800 for the general business credit. General business credit is non-refundable. So let's remind ourselves what that means. You've got two different types of credits in the tax law, refundable and non-refundable. Refundable means that not only do you get to use it to eliminate your tax liability, but if you've got more credit than your tax liability, you get a refund of the difference. So if your tax liability is $3,000 and you have a $4,000 credit, then that credit will wipe out your tax liability altogether. So you'll owe zero, and the government will send you $1,000. That is a refundable credit. A non-refundable credit says we will wipe out your tax liability, but we're not giving you anything more. So if you had that $3,000 tax liability and a $4,000 non-refundable credit, it would wipe out your tax liability to zero, but that extra $1,000, they would not send you a check. So these are non-refundable credits. And again, just reminding you, a tax credit is a dollar for dollar reduction in the tax due, as opposed to a deduction. A deduction lowers your income, so it gives you an indirect tax savings. A credit, though, gives you a direct tax savings, dollar for dollar reduction in the tax liability. So not only is it non-refundable, but it is also limited to the greater of your tentative minimum tax or 25% of the amount by which your regular tax liability exceeds $25,000. So it's limited to the larger of those two, your tentative minimum tax or 25% of the amount by which your tax liability exceeds $25,000, and that's only $12,500 if you are married filing separately, and then only if both spouses qualify for the credit. Excess credits can be carried back 1 year and forward 20 years. So it's non-refundable. The government is not going to send you a check for the difference, but they are going to let you use it. You can carry it back 1 year and you can carry it forward 20 years. So as long as you can use it during that time frame, then you will get to use it eventually. They are treated as used on a first in, first out FIFO basis by offsetting the earliest earned credits first. Therefore, the order in which they are used is carry forwards to this year, the earliest ones first, then credits that were earned this year, and then carrybacks to this year from future years. That's the order in which these credits are used. And the credits are used in a particular order depending on the type of credit that we will show you on the next slide. So this is a list of all the credits that are included in the general business credit, and this is the order in which they are used. So let's zoom in a little bit on this. So you can see the very first one is the investment credit, and then within the investment credit, there are different specific categories of credits, and so it shows you the order in which they are used. And then you see all these other ones: work opportunity credit, biofuel, etc. And you can see this is quite a long list of credits. We are not going to go into all of these credits. We are only going to talk about a few of the ones that are more likely to be tested on the EA exam. So we will start with the disabled excess credit. This is eligible for small businesses. They can claim a credit for expenses to make the business accessible to people with disabilities. The credit equals 50% of eligible expenses up to a maximum of $5,000. If the credit is claimed, you cannot also claim the same expenses as a deduction. And you're going to see that's a common theme, and that's just going to apply anywhere. If you've got expenses that you are claiming a credit for, you cannot also deduct those expenses. So you have to do one or the other. You either deduct the expenses or you claim the credit. But claiming the credit is going to be a better deal because remember, a credit is a dollar for dollar reduction in your tax, whereas the deduction gives you only an indirect tax benefit. Now, I said you're always going to want to take the credit, but it may not be always. Maybe you have so many credits that you're going to wipe out all of your tax. And remember, these are non-refundable. And yes, you can carry it forward or carry it back, but you might say, you know what, instead of doing that, I'm going to claim as many credits as I can to wipe out my tax liability. But then after that, I'm going to just deduct the expenses instead and create lower tax or net operating loss. And that's fine. You can do that if you would like to do it. So you can look and see which way gives you the better answer, but you can't do both. You can't both deduct them and take the credit for those same expenses. When we say here eligible small businesses, you don't need to worry about for the exam what it means to be an eligible small business. If there's a question about this, they will tell you that it is an eligible small business. What they're going to focus on is it's the 50% of expenses up to $5,000. That's what you're going to want to remember. Credit for increasing research activities. So we're going to spend a couple of slides on this. It's important. This is also known as the research and development credit or the R&D credit or the research and experimentation credit. The R&E credit is reported on Form 6765. There is also a research and experimentation deduction that can be amortized over 5 years. So it's the same type of expenditures, but again, you can't do both. You can't amortize them and take the credit. You need to separate those out and do one or the other. This credit is allowed for qualified research. And there's a section 174 that talks about what qualified research activities are. So it has to be qualified research. Must be undertaken for discovering information that is technological in nature, and its application must be intended for use in developing a new or improved business component of the taxpayer. Substantially all of the research must be elements of a process of experimentation relating to a new or improved function, performance, reliability, or quality. So there are specific rules about, we're talking about technology here, and these specific applications of that technology in order to qualify for this credit. So you just read the slide over and get this feel for the types of things that are allowed. Here's a list of things that are not allowed under this credit. Research conducted after the beginning of commercial production. So the idea of this is that you are researching for new things, new technologies. Well, once you've already started commercial production, then you can no longer take the credit for this research. The expenses can still be deductible, but you can't take the credit. Also, you cannot take the credit for research adapting an existing product or process to a particular customer's need. So a customer comes to you, say, hey, I love this, but this is what we need it to do this. And so you do some research in order to make it do that. Well, again, you can deduct the expenses of that, but you cannot take the credit. Duplication of an existing product or process. This credit is for coming up with new things, not for duplicating things that already exist. Surveys or studies. Maybe you're going to go out and do a survey of your customers or of the marketplace to find out what would customers like to see. Well, that might be a good thing to do, but that is not research as far as this research credit is concerned. You're not actually researching the technology. You're just doing market research to see what technology you might want to develop, but you can't use that market research as part of this credit. Research relating to certain internal use computer software. So this is supposed to be for developing new products to bring to the marketplace, not for using for your internal purposes. So you can't use it for researching things for your internal computer software. Research conducted outside the United States, Puerto Rico, or a U.S. territory. So it's not research done in foreign countries. You cannot use that for the credit. Research in the social sciences, art, or humanities. So again, this is about technology. And research funded by another person or governmental entity. So if somebody else is paying for it, then you can't take the credit for those expenses. Qualified small business. If you have these research activities that are being done by a qualified small business, then you can elect to take a payroll tax credit instead of an income tax credit. So this is for qualified small businesses that can elect to use up to $500,000 of the credit against the employer's share of Social Security taxes. So you might be asking, why would we do this? Well, if you've got a startup company, a lot of these technology related startup companies, they don't make money at first. They're losing money. So they don't have any income tax. So an income tax credit does not do them any good. So what they're saying here is if you got a qualified small business like this, then instead of an income tax credit, we're going to give you a credit against the employer's share of Social Security taxes. So that can be very valuable because remember, the employer has to pay in 6.2% of their employees' salary up to the annual limit. And so they're going to let you get a credit for $500,000 of that, which is a great deal. Now, in order to do that, it has to be a corporation or a partnership with gross receipts of less than $5 million for the tax year, which again, if you got a startup type of company, they probably don't have a lot of gross receipts yet. So they're probably going to have less than $5 million for the tax year and no gross receipts for any tax year before the 5-year tax period ending with this tax year. So again, this we're looking at startups. So what this says is less than 5 million this year and no gross receipts in the 5 years before this year. And so that's what this is targeted for, these smaller startup type of businesses. Small business healthcare tax credit. So this is for small employers who provide health insurance to their employees. In order to qualify, the employers must have fewer than 25 full-time employees, or what they call full-time equivalent employees. They have to pay average wages of less than $62,000. That's the 2023 number. They must offer health insurance through a small business health options program marketplace. So this is like part of the ACA where individuals can go get health insurance. They also have small business options, and so it has to be provided through that marketplace. And the employer must pay at least 50% of the cost for employee-only healthcare coverage. They don't have to pay 50% of the cost for family or dependent coverage, but they do have to pay at least 50% of the cost for the employee's portion of their health insurance. The maximum credit allowed is 50% of the premiums for small business employers and 35% of the premiums for small tax-exempt employers. So 50% for businesses, 35% for tax-exempt employers. The credit is available for 2 consecutive years, beginning with the first year the employer offers the plans. The amount of the credit works on a sliding scale. The smaller the employer, the bigger the credit. And the credit is refundable, so tax-exempt employers can still benefit, though the credit cannot exceed certain payroll taxes the employer owes. So in other words, even if you're tax-exempt, you can still get a check from the government for this, as long as the amount does not exceed certain payroll taxes that the employer owes. Next is the foreign tax credit. We covered this in individual tax, but just a reminder, it applies to businesses as well. If you pay income tax to a foreign country, you can get a credit against your U.S. taxes for up to the amount of the United States tax that you would have had to pay. Can be unearned or unearned income. It's reported on Form 1116. If all of your foreign income is passive or investment type income, you usually don't need the 1116. Any excess credit can be carried back 1 year or forward 10 years. And you can choose instead to deduct these taxes instead of taking the credit. But again, it is usually better to take the credit. Well, that is the end of video 4. I appreciate you hanging in there. I'll see you on video 5.